It is no exaggeration when I say this week is critically important for markets because let's face it, right now, the correction in the S&P, the NASDAQ, and small caps, and pretty much everything else, staples have held up a little bit better, is because of recession concerns. Yes, we care about tariffs, but tariffs lead to inflation or weakening growth, maybe both. That's the stagflationary argument. But really, this week is going to give us a little bit more clarity on the state of the consumer and on the economy. And let's face it, if you actually do the work, if you do the due diligence on our markets, like listen to company earnings calls and keep up to date with what's going on with the consumer, you're not very optimistic heading into this week. Now, maybe that means we could have a positive surprise. We'll talk about that in this video, but there's a couple specific data sets that are hard data that are going to be hard to ignore if they come in weak. Specifically, PCE and retail sales coming out on Friday, but you also have durable goods orders and a couple of other big catalysts, all of which I will go over with you in this video. Also a lot of fears of companies that start pre-announcing negative earnings. We've heard this on CNBC, on Fox Business. We've heard this concern out there. And if you are going to get a pre-release, it could be this week. So be on the lookout for that. Now, I have went over on this channel at least 5 times why I'm not super bullish on this market. And let me just go over this again. I think most people would agree there's probably a 30 to 50% chance of a recession this year. Even some large banks have recession odds at 25 to 30-ish%. Okay. I would say recession odds are maybe a little bit higher than that, probably closer to 50%. And here's the problem. The average EPS drop on the S&P during a recession year, excluding 08-09, because there was so much in losses in the banking sector, EPS was so negative there that it really just skewed the overall number. Like the EPS drop in 2008, 2009 was like 50%. That's not average during recession. So excluding that, you get a contraction of EPS of 15%, negative 15% year over year. So while we don't have all of Q4 earnings out the way just yet, you're going to be roughly around $237 of EPS for the S&P for 2024. Well, you times that by the multiple that we were at was about 21, and well, then you're at, 4,900. But what people have really been doing is saying EPS is going to be about $270 this year, right? That's the expectation on Wall Street. Times that by 21, you're looking at 567 on the SPY, which is roughly where we are today. Okay. The issue is, if we do go into a recession, the average EPS decline year over year is 15%. So take 237 times 0.15. That's going to shave off about $35.55 to EPS. So just simple math, we'll shave off $35.55. You're looking at about $201.45 of EPS this year. That could happen. Now, what's the multiple on that look like? If it's 21, then you're at $423 on the SPY. That is massive downside from current levels. Okay. 421, you're going down 25% from here. Okay. And that's at a 21 times multiple. That's at a very rich multiple. The average recession multiple is 15, but on the high side, you could be at 17. At a 17 times multiple, you're at $342 on the SPY. Today, we're at 563. So 342 on the SPY. I gotta zoom this out. you're going to be back to like 2022 lows. So just in a nutshell, I mean, that's downside of almost 40%. So that in a nutshell is why I'm not super excited about buying the dip here. That's just my personal preference. I think the risk is too high, versus the upside risk, right? Because you always have upside and downside risk. The upside risk is if you're all in cash, you're out this market, and markets could go dramatically higher, then you're going to miss out on a lot of gains in this market. But even if things go perfect, just getting back to new all-time highs in light of new information in the past 2 months or so, it's going to be fairly difficult to do. And that's about an 8 to 10% upside move. But you could be looking at 40% downside if the 30 to 50% chance or odds of a recession come about. That's why this week is absolutely critical. And yes, there is, unfortunately, 3 to 5 times more potential downside than upside in the short term. Now, long term, I think things are going to be fine. Tariffs will work itself out. The economy is very resilient. Okay, we all know that. But I'm talking about this year. I'm talking about the cost of capital. Okay, there could be a chance to put money to work at better prices. Not a guarantee, but a possibility. So first, before we get into the economic data of this week and some of the headlines that are coming out via the trade war out of China that are very important, you want to hear this, let's take a look at the earnings lineup that we have this week. So tomorrow in after hours, you have Oklo and KB Homes. KB Homes is going to be important. How is demand looking for the housing sector? We've gotten a lot of mixed data for housing, and a good report there may stave off some of the fear that investors have. Tuesday, pre-market, Canadian Solar, Rumble, McCormick, some other names. Tuesday and after hours, GameStop. Wednesday, pre-market, Dollar Tree, Chewy, Jinko Solar, Cintas, and some others. Paychecks. Wednesday in after hours, Microvision, Petco, Jeffries, and Miller Kroll. Thursday, pre-market, Bitfarms, Winnebago, in after hours on Thursday. Probably the most important company, I would say. Dollar Tree is obviously important too, but Lululemon. How is the higher income consumer doing? Because 50% of all dollars exchanged in the economy come from the top 10% of income earners. Why I've raised my recession odds so much this year is you've already seen the lower middle income consumers in a recession for like 2 years now, right? The inflation crisis has just killed them. But the higher income earners tend to be business owners. They tend to own stocks. They tend to own, nice homes that have a lot of equity. The wealth effect could be reversing. Definitely you see that in stocks, but also in real estate. And now you're adding this tariff uncertainty, and it's really affecting business decisions and confidence in those higher income earners, okay, which tend to be business owners, right, tend to own assets. You actually heard this from Fed Austin Goolsbee on CNBC, where he said that from the business leaders he talks to in his district, which is Chicago, they're reporting a sharp increase in anxiety in pausing CapEx plans and really just waiting for clarity. That could be a big issue if it continues, but unfortunately, I think the damage is kind of already done because I don't see the whole trade war going away anytime soon. So Lululemon could be important because they cater to higher income earners. So watch that one carefully. And before we go ahead and get into the economic data of this week, you should see these comments coming out from China, citing Li Qiang, I probably butchered that. I'm not great with names, okay? Especially not Chinese names or foreign names. But it says that China and the U.S. should promote stable ties. China's Li Qiang says that there are no winners in a trade war. Donald Trump on Friday said that he was willing to talk to China on tariffs and quote unquote be flexible. So maybe that headline could spark a little bit of optimism in the beginning portion of this week. Now, whether or not that's going to matter, again, comes down to the economic data, because believe it or not, you're not priced for a recession at all. So starting off on Monday, you have more of your soft data. Chicago Fed National Activity Index, expecting that to be a little bit better than last month. S&P Global Composite PMIs for March, expecting that to be a little bit worse. Manufacturing PMIs, expecting that to be a little bit worse. And Global Services PMIs, expecting that to be a little bit better. But services are almost negative. Anything below 50 is negative technically. So you want to watch that. Markets will react, but it is only soft data when all things are said and done. On Tuesday, you have Fed Williams that speaks. You have the house price index month over month and year over year, and S&P Case-Shiller home price month over month. Fed Kugler speaks in the morning as well, and all of this data comes out at like 7 to 9 o'clock in the morning before markets even open. You also have Richmond Fed Manufacturing Index, manufacturing shipments, and services revenues. But again, all of that's more soft data. Soft data has been very weak recently, and as Grok will tell you, soft data usually translates into hard data. It tends to be a leading indicator for economic trends, but doesn't always happen quickly. It's not like you get soft data one month, the next month the hard data goes to shit, right? Sometimes it can work like that, but not always. It can be a really early indicator of economic trends shifting. On Wednesday, you get your first set of hard data. That is durable goods orders month over month for February. We've seen a spike in January. It went up 3.1%. Now, durable goods orders are not necessarily like staples, right? They're more discretionary items in nature. And you got a boost here, I think, because of the tariff issues in January. Companies over-ordered. We heard from Ollie's, which buys like excess inventory at discounts and then sells them for cheaper at their stores. Ollie's, if you're on the East Coast, you know what Ollie's is. If you're on the West Coast, you probably don't because they're not over there. But essentially, it's a discount retailer, kind of like Ross, right? Ross, Dress for Less. Kind of like that, but they sell everything. Well, even their CEO was talking about on CNBC. You could watch this clip yourself. I watched it. It's not, I could explain it. I'm not going to, go over it, but just look up CNBC Ollie's and you'll see what I'm talking about here. The CEO said that a lot of companies ordered a lot of things via tariffs and demand is weak for a lot of these discretionary items. So could be a lot of inventory buildup, a lot of discounting, and Ollie's plans to take advantage of that. Nonetheless, durable goods orders is hard data. You're expecting a negative month-over-month number of 1.2%. Again, if that comes in more negative than expected, that's not a great sign for the economy, to say the least. So that's your big data on Wednesday. Fed Kashkari, Fed Musa Liam also speak at about 9 o'clock in the morning as well. On Thursday, you will get the GDP growth rate quarter over quarter. Initial jobless claims, wholesale inventories, continuing jobless claims, real consumer spending quarter over quarter, Kansas Fed Composite Index, Manufacturing Index, Fed Barkin that will speak as well. So lots of data coming out on Thursday. The big day, though, the huge day is Friday. That is core PCE month over month. You're expecting 0.3% month over month, the same as last month, so not much of an improvement there. But guys, the big data is personal spending, because spending is such a large chunk of the economy. You're actually expecting a good number here. Last month was negative 0.2%. That was the worst number we've seen since the COVID drop, believe it or not. And you're expecting a 0.6% month over month reading. So take a look at this. We haven't had a negative personal spending number in the last year. In the last 3 years, we had a negative number March of 2023. You had even in like November of 2022, when everyone thought we were going into a recession, you were only at 0%, right? So you're negative 0.2%. If you look at the last 5 years, you could definitely see this thing really starting to slope down. You had a really negative number February of 2021, and then that rebounded sharply the next month. So you really have not been here since like the COVID days, especially if we get another negative number. We have not gotten 2 back-to-back negative numbers, since COVID, right? So if that were to happen, that is a big red flag because this is hard data. It's not soft data. You also have personal income month over month, expecting that at 0.4%. Honestly, at this point, the lower the better. And again, PCE, the lower the better there as well. You will get final numbers also for Michigan consumer sentiment, inflation expectations on the 5-year and 1-year, probably what markets are going to react to the most, but also current conditions, consumer expectations will be important as, again, soft data kind of just judging where the economy's at. Really do think this week's economic data, especially on Friday, and unfortunately the big data is on Friday, so whatever happens throughout the beginning and middle of this week is only going to matter so much because of that big data on Friday. So whatever happens on Friday, it's really going to drive the move for markets. Now, April 2nd is the big tariff deadline. Now, that is not this week, but next Wednesday. And again, I don't think tariffs are really a huge catalyst at this point. For better or for worse, we know tariffs are coming. They're supposed to be, quote unquote, reciprocal. There may be a deal done, blah, blah, blah. If the trade war were to end, it would lower the odds of a recession because then businesses could put capital to work. But then again, like, are we just going to like accept that the end is the end? Or is there going to be that lingering uncertainty that something could change, right? Think about it like this. If you're Apple, for an example, and you can make a factory cheap and run a factory cheap in China with cheap labor, but you're going to have to pay a tariff. Okay, so you build a factory in the US. Great. Now you don't have to pay a tariff. Maybe, it's, a little bit cheaper, whatever. But what if it all ends? Or if there's a shift and there's higher tariffs on China, or maybe no tariffs on China? Then you got screwed because now you're building a factory in the US. That's great for the American worker, don't get me wrong, but that's bad for margins, right? So it's not a lot of urgency to make big decisions right now. And I don't know how fast that's going to come back, even if we did get the end of the trade war like this week or next week. Again, what are the odds that the trade war just ends abruptly and there's no tariffs? Probably 5 to 10%. So it's not impossible, but it's not very probable at the same time. So again, on the downside levels, we're below your 200-day moving average on the SPY. It's the 300-day moving average. 300-day moving average is sitting at about 546. If this week is bad, you're definitely coming down to that level. Probably going to undershoot that. 540 would be really the level I would want to watch. This would only take you back to like where you were in September, right? Which I don't know about you guys, but September of 2024 does not feel like it was all that long ago. So we're really still very elevated on the markets. You just really gave up that whole Trump bump after the election. Now, if things were to get even worse, then you fall to about $500 on the SPY, and that's your 500-day moving average. I think, again, the risk reward on markets starts to look really good when you're down about 18, 19%. Because then at that point, I see the risk reward at, to some degree, a parity, right? So if you get down to 500 on the SPY, I look at it very simple. At $500 on the SPY, I think you are, again, 50-50 chance of bouncing back up to 600. That's a $100 gain on the SPY. There's a 50-50 chance of falling even further to $400 on the SPY. That's a 1-to-1 risk parity. I would feel a lot more comfortable, even if we're going into a recession, or maybe not, putting capital to work at those levels. So 500 on the SPY is the magical number, I think, where you can get more bullish on this market, or at least when I will get more bullish on this market, because again, that's roughly 20% upside potential and 20% downside potential. Right now, you're sitting at like a 40% downside potential and 10% upside potential. If you fall another 10%, you're going to be sitting at a 20% upside potential and a 20% downside potential. So that's when the risk becomes at parity. It's kind of how I'm looking at markets. And I don't think this is a market you have to rush into. I don't think we're V-shape recovering back to new all-time highs anytime soon. But then again, I've been wrong before. So come to your own conclusions. Let me know what you guys think about that down below in the comment section. Have a fantastic rest of your day, and I will see you in the next one.